Hello, everyone, and welcome back to the podcast. Today, we're taking a look at something a little off the beaten track for us, but nonetheless very interesting, which is Polymarket and insider trading charges. We're discussing an important enforcement development involving these new prediction markets and digital trading platforms, and notice the expanding reach of DOJ and CFTC enforcement activity. Recent insider trading charges tied to trading activity involving Polymarket provide an important window into how regulators are approaching emerging financial technologies and event-based digital markets. This case demonstrates that federal prosecutors and regulators are adapting traditional insider trading, fraud, and market manipulation theories to entirely new technological environments. Prediction markets have grown rapidly over the last several years. These platforms allow users to trade contracts tied to future events, elections, economic data, sporting events, geopolitical developments, and many other categories. Supporters of prediction markets often argue that these platforms improve information aggregation and forecasting efficiency. But regulators see substantial risks as well. Those risks include market manipulation, misuse of confidential information, fraud, customer protection failures, AML weaknesses, sanctions exposure, and potential unlawful derivatives activity. One of the most significant aspects of the case is the application of insider trading concepts outside traditional securities markets. Historically, insider trading enforcement centered on stocks and securities trading. But over time, enforcement theories expanded into commodity markets, crypto assets, and digital asset trading platforms. Now we are seeing those same principles applied to prediction markets. The core theory remains simple. Market participants cannot misuse material non-public information to obtain unfair trading advantage. What is especially notable as well is DOJ's increasing reliance on broad criminal statutes like wire fraud and conspiracy. This strategy gives prosecutors substantial flexibility because they do not necessarily need to resolve complicated classification questions involving whether a particular digital product is technically a security, commodity, swap, or derivative. Instead, prosecutors focus on deceptive conduct, misuse of information, and market integrity. The Commodity Futures Trading Commission also plays a central role here and has long expressed concerns regarding event contracts and prediction markets. The agency's focus includes whether these contract functions are commodity futures, swaps, binary options, or prohibited speculative instruments under the Commodity Exchange Act. But beyond the classification issues, the CFTC is clearly focused on broader market integrity concerns. And these include fraud prevention, manipulation, detection, customer protections, record-keeping obligations, and surveillance capabilities. The government is signaling here that prediction market platforms should maintain compliance infrastructures comparable to traditional financial institutions and regulated trading venues. So prediction market operators now have to assume they face rising expectations involving transaction monitoring, suspicious activity detection, employee trading controls, insider trading prevention, AML compliance, sanction screening, and governance oversight. Another important issue is information barriers. Platforms often possess sensitive information involving market issues, market listings, contract approvals, dispute resolution processes, operational changes, or other non-public developments. Without strong controls, employees, contractors, consultants, or affiliated traders may create serious insider trading risks. This also ties into broader DOJ crypto enforcement trends. Over the past several years, DOJ has dramatically expanded enforcement activity involving digital assets and emerging trading ecosystems. We've seen enforcement actions involving wash trading, spoofing, market manipulation, sanctions violations, money laundering, unregistered exchanges, and insider trading involving digital assets. Prediction markets are now becoming part of that broader enforcement category. Another key issue is jurisdiction. Many prediction market platforms operate globally or use decentralized structures, but U.S. regulators continue asserting jurisdiction aggressively whenever U.S. users participate. U.S. infrastructure is utilized or U.S. markets are affected. Global operations do not eliminate U.S. enforcement exposure. From a compliance standpoint, platforms need robust surveillance systems, strong governance and escalation procedures, sophisticated AML controls, and active board oversight. The larger message from DOJ and the CFTC is pretty straightforward. Prediction markets are not beyond regulatory reach. Well, thanks, everybody. Thanks for another episode, and we'll see you soon with yet another topic in the area of corruption, crime, and compliance.